your head might hurt a little bit after this. There's a lot of stats and numbers and context, but this is good stuff. So I would just say, though, that we are in one of the most craziest markets I've ever seen. I mean, raise your hand if you've ever seen something more crazy than this. No, I doubt any hands would go up, right? It is simply a stranger market, all right? And so let's unpack that today. I would use words like it feels like chaos out there. It's so hard on buyers. The supply and demand, it's just so lopsided, all right? And so let's begin to dive into stuff though. You guys, a couple of you may have seen this, but a couple months ago I shared this on Twitter and I said, caption this. And here we have a manufactured home, driving on Highway 50, and then someone said it perfectly. They said affordable housing leaving Sacramento. And I think that's, as we're looking at skyrocketing prices and things that record-breaking prices, not only in Sacramento County and the region, but the state, the United States. I think this conversation of affordability is definitely on people's minds. And so we'll unpack that throughout the presentation, but let's jump into some stats. So here's the region. And when you look at last year versus this year, the top three rows in this chart, you can see we basically had 20% price growth. Now, we're now in our 10th year of price growth. It's very uncharacteristic to see prices up this high. If anything, I think a lot of us would have thought that maybe we would see prices up 4 to 6%, something very modest, but all of a sudden we have this market that is on steroids, okay? And I have images like this for Placer, Sac, and even El Dorado County. If you need those, you can send me an email. But basically, one of the best ways I've been describing the market is it's like a Tesla. And any Tesla owners out there, if you can let me know in the chat, I'm an aspiring one. I'm a Tesla convert after riding in my brother's a couple months ago. But Tesla has what's called insane mode or ludicrous mode. And what happens in a Tesla, you push this one button and then the car will go exponentially faster. And what happened in our market, if you noticed around midsummer last year, is that there was a button that was pushed. It was mortgage rates below 3%, and our market went absolutely haywire. But not just then, I would say January through March we've seen very, very rapid appreciation, right? Are you seeing that in neighborhoods you're working in? I bet so. And Jennifer, glad to know that you have the Model S. So what a cool car, right? But here's sort of what I was talking about. For a while, the market was slowing down. And what we see here in this image is that you see price growth, from 0 to 14%. And through the years, 2014 onward, the market was still experiencing price growth, but it's like there was less price growth. It's like the market was going a car going 70 miles per hour, and then all of a sudden it was going 35. But what happened last year, the market sped up. And so this has been very uncharacteristic to see this type of growth, okay? This image comes from Lundquist. Everything is really small on purpose. If you need the bigger one, just send me an email. But I basically wanted to highlight that what we're experiencing in Sacramento is happening all across the United States. And you can see price growth in all different metros, Atlanta and New York and Seattle. You see this uptick, almost everywhere. It just shows that the market was slowing, but it sped up in a significant way during a global pandemic, right? Here's the Sacramento region. The black bars represent the month of March, okay? And this is a median price. And you can see in March, as you look at through the years, it's very normal to see prices increasing during the spring season. But what we saw a huge jump from February to March, very uncharacteristic, especially in our 10th year of price growth, right? Here's another way to look at the market just to see how disconnected prices are from the normal trend. Here's 2021 in orange, the median price, and look how far it is. Look at this white space from last year to this year. So in a normal year, you can see prices sort of go up, for about half the year, and then they sort of slough off, okay? In 2020, look, prices went up, and then prices did decline for a very short period of time, maybe 4 to 6 weeks at the most. And then there was this dramatic rebound where prices just skyrocketed, and we didn't have a normal slough. Okay, we didn't have a normal sort of fall lull. The market just basically kept going up, and so we started this year about $40,000 higher than normal, and then we've just gone from there. Okay, but we have this incredibly hot market, and my sense is it feels like an auction. Do you think that's a good way to describe it? Let me know in the chat if you would like. I feel like buyers are looking at prices, and sometimes, appraisers are showing up to properties and going, "God, there's no way I can even support that contract price. It's so far up there." Okay. And Susan asks, is normal stuff, is the normal stuff due to increased inventory at that time? We'll get into inventory in a little bit later on. So hold that thought. If I don't get to it, definitely talk. But here's the Sacramento region, though, since 2012. In 2012, we had the bottom of the market. Now, I just pulled these stats this morning. They're as fresh as can be. But when you compare January 2012 with right now, look at the dollar change. The median price is up over $300,000, no matter which county you look at. And so it's just amazing. And so theoretically, if you have a house, it's maybe worth 300,000 more. That doesn't translate perfectly, okay? But a lot of houses have seen massive equity. But here's a percentage change, and depending on the county, Sacramento 200%, Placer 138%, okay? Sacramento had the lowest prices, and so when you add on to that, you see the highest gain. All right, just phenomenal. But here's a look at different neighborhoods in just Sacramento County. Maybe I can hit Placer at some point too, but you can kind of scroll down and just check it out to see the dollar change and the percentage change. We've just seen profound, phenomenal growth in the area. You can screenshot this, or later on, either Safe or myself will get this presentation to you as a PDF. The hope is that it'll be reposted on YouTube also. And so don't worry if some slides go too quickly, but just phenomenal growth. One thing I wanted to mention, look at Oak Park. I think sometimes we look and go, what in the world? 600% growth. Okay, and that's an astounding figure. We all know sort of what's been happening in Oak Park with growth or gentrification and whatnot, but Oak Park, the number started out so small. 50,000 was the median price. And one of the reasons why it's able to show 600% is because that first number was so small. And so just keep that in mind. That's sort of how numbers work. But what about the elephant in the room, though? Let's talk about Zillow and iBuyers. And in the chat throughout here, I'm comfortable talking just myself, but if you want to pitch in any thoughts throughout any of this time or you have questions, let me know. But what I want to do is I want to show you the activity. What are these groups focusing on? All right, in our market right now, as of this morning, fresh stats. So iBuyers currently own 96 homes in the Sacramento region. Okay, just pulled this up from tax records today. And here's the breakdown. You can see Redfin owns 11 homes. Zillow has 36 homes, and Open Door has the most at 49 homes. Now, the iBuyer model sort of paused their operation as soon as the pandemic began, and a lot of people critiqued it and thought, "Hey, this model can't, thrive in every single market." I think that's probably a fair critique, but they've definitely picked up momentum lately. All right, I'm going to show you sort of what they're buying, but I want to draw our attention to one, I think, pretty powerful stat. Do you see this below? It says iBuyers represent 1.1% of all listings and pendings in the Sacramento region. And so what we're seeing here is that we focus a lot on the iBuyer, but basically 99 out of every 100 listings are not iBuyers. And so let's watch this. This is really important. Tech companies entering real estate, but let's also keep it in context. And David says, do you have any idea of the percentage increase for Zillow? I don't. They've really only been in our market for a year. They basically entered the Sacramento market and the pandemic happened right away. They suspended their operation. So we don't have that much data on them yet. So I think that's what maybe you meant, David. Clarify if you didn't. But here's sort of their target. The iBuyers, and I'm going to show you 3 different images. They're targeting non-complex homes. They're basically fishing between 300 and 700,000, built after 1950, 3 to 4 bedrooms, and on less than a third of an acre. And so you can see this first one shows, the price of the homes versus the square footage. And you can see not too much above 3,000 square feet, not much, very, very little above, at 700,000. The bulk is, right here in this sweet spot, first time buyer price point under 500,000. Okay. But here's the iBuyer model by year built. Literally, when I look at everything that they own right now, about 100 properties, there's nothing that they've purchased that was built before 1950. And so as you think about this model, and if you're afraid of it, if you're scared, what does the future hold? What I would recommend is focus on stuff that they're not buying then, right? And so, and Sandra says, I've been getting very high offers from Open Door for my home, crazy. Or, Tina asks the curiosity, how are you able to capture the iBuyer stat in the actives and pendings? I'm pulling that from Realist, and when you look at Realist stats, it shows if a property that's owned by any entity, if it's currently listed. And so that's how I'm doing that. Price versus lot size. Look, the iBuyer lot, there's very few above 0.25 acres. And so again, if you're concerned about this model, then focus on the hard stuff. It's much more difficult. Properties on acreage, okay? Here's a look at the iBuyer model, everything they own in the Sacramento region. And you can see a lot of it is in, more populated areas. Here's one Lone Ranger in Placerville. Here's one in Galt. And so to borrow a phrase from Star Trek, though, to boldly go where no man has gone before, I would just say, again, if you're concerned about this, then diversify where these models are not playing, okay? Find your niche, okay? But realize too, like I said, this represents 1% of the market. Okay, so for the rest of the presentation, let's focus on the 99% of the market that is not iBuyer. Okay, so let's break down the region in 2020. And by the way, where are my Breaking Bad fans in the chat? Let me know. I'm a huge fan. Cash percentage so far, January through March this year, this is the most recent stuff, 13.4% of the entire market was all cash. FHA is just under 10%. VA is just under 5%, and conventional is a whopping 70%. And so what I'd recommend is keep these things in mind and, talk with your loan officers and be aware of what type of financing are buyers using. And sometimes there's a clue into the market. There's a clue of what to communicate for your content that you're putting out there, right? For instance, if you're working with just FHA buyers, that's a smaller sliver of the market right now, okay? And one thing I would say, don't be afraid of VA. I think VA gets vilified sometimes in our market, and there's some positives for, I think, why VA works. Keep in mind, VA is the only type of loan where an appraiser is allowed to call the listing agent and say, hey, it looks like this one's not going to come in at value, so to speak. It looks like the appraised value is going to be coming in lower. And so it's a process called Tidewater where the VA appraiser can say, you're welcome to send me some comps, okay? This is 2021, okay? This is, excuse me, my heading says 2020. Thanks so much, Joni. So my bad on the heading, that was a mistake. And then the next one is a mistake also. This is 2021. Clearly, I didn't change that. Above $1 million market, okay? Cash, there's more cash above $1 million, okay? It's not just 13%, it's 24%, nearly 1 in 4 sales. FHA, 0%, okay? Obviously, FHA doesn't qualify there. VA, here's sort of a trick question. Check it out, 4.2%. So far in 2021, there's been 12 sales above $1 million that have gone VA. And so this is a sliver of the market, and conventional is totally dominant at nearly 68%, okay? Just phenomenal. So here's some ways to visualize what I just shared with you. 13.4% cash. Cash increased just a little bit lately. It's basically on par with where it was exactly 1 year ago, all right? But I think the myth, by the way, did anyone watch Mythbusters? Such a cool show from yesteryear. Cash buyers are dominating the market. It's a myth because they really aren't, okay? But everyone who works in real estate here on this video, or on this presentation, we all know where cash is dominating is conventional buyers paying above cash, to handle the appraisal gap or to maybe handle certain repairs, to give sort of incentives to sellers because they have the money. And so we don't have a market with all cash, but we have little cash playing a huge role within transactions. 9.9% FHA. FHA is basically at its lowest point in over a decade, okay? Conventional is so much more viable today, and a lot of buyers are switching conventional instead. And I think it's in today's market, statistically, we're seeing that, it is more difficult with such a lopsided feel for an FHA buyer to get a contract accepted. Yeah, but here's the thing. 1 out of 10 still went FHA, so there is some hope, okay? VA declined a little bit from the previous quarter, still about 1 out of every 20 sales in the region. All right, here's an interesting thing. We've seen FHA and VA buyers targeting 2 to 4 units more readily. People have been house hacking. And so one thing to continue to watch, because as sometimes buyers get squeezed out of the single family market, they start to look at other products, whether it's mobile homes or manufactured homes, condos, even 2 to 4 units. And so I would say watch this market in your book of business, because sometimes a first-time buyer really is an investor at the same time. All right, here's conventional, totally dominant at about 70%, just amazing. Let's talk about Bay Area buyers though. And I have some brand new stats that just got published the other day. Last week they came out, and I'm really excited to share. I have some anecdotal stuff to share, but I have some actual data from the Postal Service to share that CBRE put out, so you can see the number of buyers entering the market to a certain extent. So here's a sensational headline though. Did anyone see this last week? It says moves from San Francisco County to Sacramento County, they increased by 70% in 2020. And it's interesting because I get a lot of media inquiries about this, and sometimes I give them my take on the Bay Area. I say, look, this is a huge trend, but it's not everything. And the danger with this is that we read the headline and go, oh my gosh, Bay Area migration increased by 70%. But keep in mind, if I made $1 last year, if my wages were $1, and this year I made $1.70, I've seen 70% growth, but the numbers are both very small. And so the percentage looks sensational. And that's exactly what we have going on here. Even in their own study, look, it says, while migration was elevated, it constituted a relatively insignificant percentage of metro area populations. And so I'm not diminishing the Bay Area trend, but I am saying that even in their own study, this 70% figure kind of gets dwarfed when we begin looking at the fine print, okay? Basically, about 1% of San Francisco left for other areas. And in Sacramento, we've been the recipient of 0.3% higher population. Now, that really wouldn't make headlines if I said, guys, we saw 0.3% extra, inbound migration. No one would click on that. But if I said we saw, 70% more Bay Area buyers, then everyone goes, whoa, whoa. And so let me share some trends. Now, you'll notice the link down here. This is where I'm getting this information. There's some really cool stuff, some interactive stuff. And so go ahead and play around on this link, and you can kind of see, look, I selected Sacramento, Roseville, Folsom, people who have moved to by different, metropolitan statistical areas. And check it out. When we scroll below, San Francisco, Oakland, Berkeley, there were 14,700 people who moved to these areas in 2020. That's clearly up by 3,500 or so people from the previous year. Okay, now Bay Area migration is normal. We always have a relationship with the Bay. It's definitely heightened here. That's what the stats show. Here's San Jose, Sunnyvale, Santa Clara. About 1,000 more people moved in 2020 compared to the previous year. And the link again right here, it's from CBRE. Okay, and you can check that out in the reshare on my PDF when that gets sent out, or take a quick screenshot right now. But very, very important to watch. Okay, but here's some other stuff. Here's from LinkedIn, and you can see that Sacramento is number 3 on LinkedIn's list. Now, this is not a huge amount coming from San Francisco. 3.5 LinkedIn members for every 10,000. So we're not looking at 700 out of 1,000 people moving. Okay, so keep that in mind. But LinkedIn shows here a 5% membership change for Sacramento, and Sacramento has benefited from people, moving different cities who are presumably in business and have a LinkedIn profile, and who have relocated to Sacramento. Really interesting way to look at stats. Now here's the San Francisco Chronicle, and you can see, people who moved from San Francisco. You can check this out later, unpack the stat fully, but Sacramento is down here, and it showed, 465 people, or in Nevada County, 430. And it's interesting because I think sometimes our narrative is that everyone is moving here, but you look at the actual numbers and go, okay, that's something, but check it out. People in the Bay Area from San Francisco County, they're moving to Alameda, San Mateo, Marin, Contra Costa. People tend to move closer to where they are. And so that's why when you look at El Dorado and Placer County, guess what the number one group is who moves into those places? Sacramento County historically, okay, without fail. And so sometimes El Dorado and Placer agents, they don't focus on Sacramento County. I'd say, why would you not? Because those are the number one group that typically moves into the market. Okay, now we'll get more data later. So again, not to diminish, but I think Sacramento is not number one on the list. And let's just keep that in mind. Now, here's an interesting thing. Now, don't screenshot this because I want to show you a problem with data before we move on from Bay Area. So this is a cool tool, and I got it from the link down here from NAR. It's in a blog post they put out. Now, this deals with United States Postal Service data. And I put in Sacramento County, and here are destinations for people who leave Sacramento. Where are they leaving? They're going to Placer and El Dorado. It says YOLO. Pretty cool tool, right? And who is moving into Sacramento? And you see, look, people from Placer, El Dorado, YOLO, and such. All right, but here's a problem I noticed with the data. When I plug in El Dorado County, it shows that 100% of people who move into El Dorado and out of El Dorado are from Sacramento. Does that sound right to you? It does not sound right to me. That is not correct. And so I'm not sure what the problem is with this data set, or if NAR did something on their blog, or if it's a Postal Service issue, but it just shows that all this data is coming out, and I'd recommend look at everything, and we kind of have to give, stronger or lesser weight depending on what we're looking at, okay? And as we come to our conclusions, but ultimately, here's my takeaway. So this comes from Altos Research. If you're not subscribed to their Monday YouTube video, I highly recommend, Google them, Altos Research. It's a really important video to watch, but you can see here are the number of active listings this past Monday in the United States. There's 311,000 listings. Now we should have over 700,000 listings right now. And so we have a market across the entire country that has been very competitive. It's been so tight, so lopsided. And so I wanted to mention the market we're experiencing in Sacramento with insane appreciation is happening in so many areas across the country. And so our tendency in Sacramento, if anything, our real estate sin, so to speak, is that sometimes I think we're giving the Bay Area so much weight that we're saying the Bay is driving our market, but you back up and go, the entire country feels like this. And so we have to, not just give lip service to mortgage rates, to the pandemic, and other factors that influence value. So this is real, but maybe it's not everything, okay? So how competitive is it out there though? Let's look at some stuff. And did anyone on Saturday watch a YouTuber in a boxing match? Isn't that crazy? What world do we live in, right? I thought $50 was a little steep. I watched it on Twitter for free as soon as it was over. But here we have a market, and sorry if that went over your head. I'm fascinated by this stuff. Here we have a market in the region where we basically had 122% more offers made this March compared to last March. Like if you're following real estate, haven't the past 3 months just been utterly crazy? Well, it shows based on sales that we are absolutely seeing the craziness, okay? Now, part of this has to do with closed sales. We had 10% more sales this March compared to last year. And so part of more offers is simply having more sales happening. But you can look at this. On average, each sale had 5.2 offers compared to about half of that from the previous year. And I know when I share this, people think there's no way. I mean, everything's getting 20 offers. I'll show you in just a sec. That's really not true. But I think people look at this data and they go, it's got to be more than 5 on average. But what I want to call our attention to is, do you remember last year? We had a pretty aggressive market for March sales. Okay, the market got really dull in months afterwards when we started to get, pandemic sales. But in March, this was actually a highly competitive market. And so to be twice that number right now, it shows just how crazy the stats actually are, right? So basically last month, 74.2% of sales in March had multiple offers. Okay, so essentially 3 out of 4 sales are, probably getting bid up and have more than one offer. And that's 37.1% higher than last year at the same time. And so stats on steroids. Every time I pull stats, I'm just astounded these days. And I'm sure you are too if you're pulling stats in neighborhoods and such. But here's sort of an interesting way to look at the market. In blue, this is the percentage of multiple offers over time. There's sort of this dynamic where in the beginning of the year, there's more multiple offers, then the market begins to crest, and then there's less. And then the market heats up in the beginning, and then there's about halfway through, there's less. And so there's really this rhythm to the market. But what happened this last year is or what didn't happen, we should have seen the market follow this dotted line where we saw less multiple offers during the fall, and then we see the market heat up again in the spring. But what happened, instead of going down in the fall, the market just went berserk. And we've been on this upward trek. We've basically been seeing more multiple offers ever since things got crazy around June of last year. And so, fascinating market. Here's the number of offers, though, that are being made on homes. And you can kind of see there's this dynamic where there's way more, between 1 and 5. And then there's this really long tail. And I'll show you that long tail in just a sec. But there's this dynamic every single month without fail. And so I think a lot of people think that the graph just goes like this, like here's 1 and then, here's 20 offers, like everything's getting 20. But that's not what, I pull these stats every month. That's not what it looks like, okay? But here's multiple offers in 2020 in this yellow mustard color compared to 2021 in blue. And you could see in 2020 in this yellowish color that there were a lot more properties with just 1 and 2 offers, right? And so it's a sign of an aggressive market to have this blue line pushed down more. All right, but here's, I think, the really telling part. This is between 10 and 31 offers in blue in 2021 and yellow in 2020. We have far outpaced what is normal. Okay, and remember, last year was still a pretty aggressive market at this time. It was a hot market. And so to be this far above is just amazing. All right, and so buyers are really struggling, right? And I think every time I log on Facebook, there's agents who are saying, yeah, it's so tough on my buyers. And it just shows that if ever, you're that psychologist, so to speak, non-licensed psychologist, I think it's in a market like today where you're doing a lot of hand holding. And if you're a buyer listening to this call, I mean, you're talking to your agent and saying, is there any hope? Okay. There is. Now, let me share some stats. I think this is probably one of the most powerful images that I'll share. There's a lot of numbers here. Let me unpack some of this, though. I think that there's some really key takeaways. When you look at March 2021 compared to last year, only 6% of sales sold below their list price. And so we have a market that is mostly priced correctly. Only 6 out of 100 sales sold below the original list price. And that's just such a lopsided figure, okay? But sort of when we go down the categories, here's the interesting part. 21% of sales sold at the list price. Now, I know it's easy to look at this and think that can't be right. There's no way in the world in this aggressive market that 1 out of 5 sales have sold recently at the list price. But I got to say, that's what the stats tell us. But let's back up, because remember last year when the market was pretty aggressive in March? This is what normal should look like for a pretty aggressive market. 45% of sales sold at the list price. And so to be at 21%, to see this figure chopped in half and then some, it's telling of a very, very challenging market, okay? Now, there are properties that you can clearly get out there. that have, hopefully you can get them at the list price. It's probably not going to be, under 400,000. And, so try to, just look what's out there, spot those properties that have been on the market for 30 days, go after those with your buyers. But the most phenomenal growth here we've seen really took place between 5 and 10% above. And a lot of times when I'm pulling comps, say Rancho Cordova north of Highway 50, then I'm looking and going, okay, how far above the original list price did these comps go? And how far are the current pendings above? Because then I might be able to give good advice to buyers. I might go, it looks like they're 5 to 10% above, or they're about 20,000 or so above the original list price. Well, here's what you need to offer probably to be competitive. Okay. And so, just look at those figures. But am I the only nerd in the room? I just think this is so fascinating. Here's a brand new image. Just pulled the stats this morning. So excited about this. How long are properties on the market right now? Okay, so the average days on market is in green from 2013. And you can see over the past couple of years, the average days on market has just screamed down. And the median days on market is in blue, similar dynamic where it's going down. The median days on market, that represents half of all sales in the market, okay? Now, check this out. The median so far in the region for all of 2021 is 1 week. And so it's fair to say that half of all properties so far this year are selling in 1 week or less. And so we want to tell that to our sellers to say, so if you're not getting any offers, maybe the market's telling you to lower the price, unless maybe it's a unique listing, needs to be exposed longer, $1 million, property needs longer exposure. Okay, but look at the median days on market from September, October, November, December. I mean, we've been at 7 days for a while here. And Steve, so glad you're here and so glad you're nerding out. January saw a little bit of an uptick. Remember, January reflects December more than anything. The market did cool somewhat in December. But ever since January, the market, we got that steroid pump and it has been going crazy. My sense is that rates began to go up and I think buyers charged the market because they recognized rates are going up, I better get in. Okay, but you can look, 6 days so far, February, March, April so far, 6 days as a median. Pendings since April 1st, 6 days of market exposure. And so pendings are the clue into the current market. And so, guys, the market has not been really slowing down discernibly. There have been a few agents who have been reported, I feel like I'm getting a little bit less offers on our properties. There's a little bit less traffic, but so far as the stats are showing a really, really competitive market still. And by the way, in the chat, what are you seeing out there? What is the temperature gauge? I would love to hear your perspective and what's going on. So here's some compelling stuff in terms of how to focus business. And, first, Cassandra asks, is there any data that this influx of buyers has to do with the millennial generation? I've not seen any compelling data yet. I do know that the millennial generation is the largest generation now, overtook, the boomers. And so, and I know that millennials are at a ripe age for home buying and for family building. And so be on the lookout, stop your millennial jokes if you're in real estate, okay? Unless it's with avocado toast. As a Gen Xer, I would say that stereotype, I embrace that for my generation too. But unfortunately, I don't have data there. Someone has to have something out there though, Cassandra. But check this out, the $1 million market has been on fire lately, okay? And you can see the percentage of $1 million sales from 2003 through 2021. About 5.3% of the market in 2021 has been above $1 million. And look, this is a percentage that's higher than it has been in previous years. But we also have to realize that, look, 95 out of 100 sales aren't $1 million. And so let's just realize that. But here's a compelling stat. When you look at $1 million sales this first quarter of 2021, they're 170% higher than last year at the same time. Or here's breaking down the numbers. There were 109 last year during the first quarter, and there were 294 during the first quarter of 2021. And so we have this market that is vibrant, that is very alive, that's moving very, very quickly. But here's, I think, there's a really, really important takeaway when we're talking about price stats right now. Okay, so this looks at July to March of this year, and it compares it July to March from last year. And so basically we've seen above a million during this period, July to March, we've seen 127% more $1 million sales. Or look, between 500 and 750, we've seen about 62% more sales in that price point. Or under 300,000, there's been 53% fewer sales. And you're going, where are these sales under 300,000? Exactly. Like, so some of this is normal. We've had a market with explosive price growth. And so we would expect for these numbers to look exactly like this, okay? But I think here's the takeaway. There's, 27% fewer sales under 400,000 and about 95% more above 750. So we have this market that's lopsided where there's less sales happening at the bottom and then there's way more at the top. And so do you know what that does to price stats? There's less at the bottom and more at the top. It pushes up the price stats. So when you're talking to clients and then they're saying, I can't believe prices have gone up 20%. First of all, that doesn't mean prices are, up that amount in every neighborhood. But secondly, we've got to understand how to explain that. And part of it is this dynamic. We have more at the top and less at the bottom. All right. Does that make sense? If not, let me know. But basically, when you look at the $1 million market, on average, they sold 6.42% below their original list price last month. And so I would say that this is a market that's on fire, but it's also a market that tends to be the most overpriced. Sometimes you look at properties and they make the Sac B, and then they never end up selling because they were priced, $1 million too high, right? And by the way, did anyone have that haircut in the 80s? I'm proud to say I never had a mullet. I did have some crazy skater cuts though. So here's a closing tip on the $1 million market though. And you can kind of see, here's March sales, and this is price per square foot, okay? And so based on square footage, 1,000 square feet to 8,000 square feet. And here's the trend. Basically, the larger the house, the lower the price per square foot, okay? That's a dynamic we see in almost every neighborhood, but I find here's the danger regardless of the price range. So share a graph like this. Is it the property? Imagine someone has an 8,000 square foot house and they see last month that there was this one property that basically had 800 price per square foot. And what they do, they take that price per square foot and then they apply it to their 8,000 square foot house and they say, list price, so easy, 6.4 million, boom, let's get it done. Instead, what they should be asking is, what if other really large size homes sold for? And chances are they might be at much lower prices than that 6.4 million. So my advice, be careful about hijacking that really high price per square foot. Look to actual comps, okay? Here's the interesting thing. I guess this is my last $1 million slide. Kind of had a lot today. This is starting to feel like $1 million talk. Sorry, guys. But check this out. This is inventory in Sacramento County above $1 million. And what happened around June of last year is that inventory actually in every price range, I'll show you in a little bit, just fell off a cliff. Okay, mortgage rates went down and people went on the move. They said, forget this pandemic thing. I'm going to make my dreams come true now. I want to get in that house. I want to move counties. We want that house with the pandemic backyard and the pool. I mean, all those things. But look, the $1 million inventory has been floating somewhere between 2 and 3 months, when normally it would be closer to 7 to 10 months. And so we've seen this diminished inventory at every single price range in the market. Okay. So is a foreclosure wave coming? A couple quick points. I've shared this stuff in other presentations. I would say it does not look like a foreclosure wave is on the horizon. That's what the stats show right now. Now, if the stats begin to change, I will be first in line to say, wow, things have really adapted. I'm going to be changing what I've been saying. But the danger is that I think some buyers are looking at the market and going, oh, I'm gonna wait until it all collapses like it did in 2005, when in fact, here we are with REOs and short sales in Sacramento County. REOs are the bank-owned sales for anyone out there not familiar with that language. We're basically at the bottom. Okay, look, 0.39% of all sales last quarter were bank-owned and 0.3% were short sales. There's basically no place we can go but up from here, okay? But regarding forbearance, this is a formal process by which owners have entered into an agreement with their lenders. We're not going to be paying our mortgage right now. We're struggling, and the lender's allowing a grace period. Okay. At one time, it was almost 9% of the entire market was in this forbearance period. But look at this. When you look at the total sales, we're now 4.5% of all loans in the United States are in forbearance. And so we are seeing a downtrend in this. And so I would just say be careful of your narrative. If you're one that likes to preach doom and gloom and you're using forbearance stats to do that, so far the stats are actually heading in the right direction. Now, I have heard some people discuss something that's interesting with buyers who are paying so far above what a property is really worth to get into contract today. And could that lead to short sales in the future? Say that the market went down. I mean, that's possible. Buyers in large are putting down more money today. But I mean, that's just a guess. I wouldn't suspect that it would be this massive, utter collapse wave type thing, but it's possible we could see more there. I do expect that some people in forbearance right now will go into foreclosure. And so I would be surprised if these numbers didn't tick up a little bit. Like I said, it's hard to get too much lower than that. And Susan says, is there any predictions as to what might happen with inventory after July 1st? Look, what's happening in the country and in the state is that we keep having, our COVID relief deadlines, our foreclosure moratoriums, and our eviction moratoriums. They're being kicked down the road. And my prediction is that that those moratoriums will probably be extended again. That's a total guess. I could be wrong, but so far that's what's happened throughout the pandemic. And so, whether that's good or bad, it's what's happening right now. Now, here's an interesting thing regarding the economy. I'm not an economist, but I just wanted to highlight, there's been a lot of glowing economic news lately. Some economists are talking about that. Okay, there's good news, but it's sort of it feels like it's a little bit slower growth in the right direction right now. But this is kind of fascinating. This comes out from, I think I got this from Bill McBride at Calculated Risk blog. Yeah, there we go. So in blue, this is hotel occupancy over 20 years. This is what it normally looks like over 20 years. Now the line in black, check this out. Hotel occupancy was right in line with the median, and then it fell off a cliff when the pandemic started. And then we've seen this recovery. It wasn't what it was last year, but a recovery. But look at 2021 in red. Pent up demand from vacations, right? Is anyone here going to Hawaii? It seems like everyone on my Facebook feed has been going there lately. We hope to get there next year. But I think that, a simple graph like this is, maybe a symptom of we're beginning to see improvement. And I think this is interesting too. This comes out from Indeed. And it shows that job postings by occupations, from February through just about 10 days ago in April. And you could see for, in terms of working from home, low remote work job postings in blue, median that's sort of a pinkish color, I think, and then high remote in, this golden color. And so the bulk of job postings out there are for workers who are, at the actual site, it looks like. It's to be determined how long this sort of remote work thing happens and whether it's really permanent or not for some businesses. But I would say watch these stats carefully because these stats represent your clients and people who are going to be buying and selling homes and playing the market. This came out from Indeed also, and it just shows that the inequity of remote work, that not everyone is working from home, but basically the higher your education, the greater the chance of working from home is. And so again, who has incentive to move, who can move, who is paralyzed in their house because of their occupation. They're not going to be moving to El Dorado County. They're not going to be, purchasing, that, second home in Tahoe or wherever, because they're not in that group that is thriving. Okay. One thing I do recommend this is to know the local market, which professions and industries are thriving versus not. This came out from Yardi Matrix from the Bureau of Labor Statistics for Sacramento. And, just say, watch the government jobs and watch the different types of growth that are occurring within the market, because in any market, some professions are going to be doing great and some aren't, and who are your clients going to be in the future? Okay, inventory has been chopped in half, absolutely. So here's some stats for Sacramento County, Placer, Yolo, El Dorado, and the region, and you could see that the number of the months of supply, it's down by over 50% everywhere. In El Dorado County, down by 75%. And so, but when you look at the days of supply, last year we had 37 days worth of listings in Sacramento County, and now it's only 17. And so it just kind of underscores, as I always say, sorry to beat the dead horse, that we have weeks worth of listings, but we have months worth of buyers. All right. And so you can unpack that a little bit later. Some other thoughts here. Let's get to Freddie Mac just published some data saying that the U.S. housing market, it's nearly 4 million homes short of buyer demand. And so we have a situation where we've had over 10 years of not enough homes being built. And so we're in this situation that's going to be incredibly difficult to solve. This is not going to be over once the pandemic ends. It's going to take many years of hopefully policy change in order to build our way out of this problem. All right, here's, I think, another troubling figure from Freddie Mac. You can see that housing supply, this is entry-level housing supply, which they would define as homes constructed below 1,400 square feet. And you can see over the past decade, it's the lowest it's been since the 70s, where, it doesn't make sense for builders to build such small homes. They can build larger homes, for cheaper on a price per square foot basis, and they're going to get it done with the larger homes. And so this is a struggle, though, because essentially the new homes become the properties that resale later to buyers, and there's less product out there. Okay. Here's inventory, though. About 6 or 9 months ago, when mortgage rates went below 3%, look what happened to inventory in every single county. It skyrocketed down. Okay, the inventory began to melt because excessive demand entered into the marketplace. Okay, here's inventory by every single price range in Sacramento County, and every single price range has gone down in recent months. And so our housing shortage, it's prominent in every range. Basically, higher prices have a little bit more housing supply, but it's really not much. It's still not what it should be. Okay. A quick closing thought before some other slides. When it comes to inventory, I think we give a lot of attention to the number of listings being down right now, but we have to realize that it's a double-edged sword when it comes to inventory. It's about supply, but it's also about demand. And one thing that's happened during the pandemic is that demand has increased exponentially. And what that's done is that's led to a lower supply. Basically, buyers are buying everything out there. Okay, and so these are kind of three of the big drivers that I'm noticing in our market. Mortgage rates being at or below or hovering somewhere in the low threes. It's a huge factor for why our market has been supercharged. Okay, migration has increased. People are on the move, not just from San Francisco to Sacramento, but from Sacramento to El Dorado, Sacramento to Placer, and such. People are making life decisions right now, and they're getting divorced. They're going through stuff. Their COVID is, I think, helping clarify people's goals. And the pandemic. Okay, we've clearly had fewer listings coming into the market because of the pandemic. And I'll show you that in just a second here. But really, supply and demand, like, we give so much attention to the number of listings. I think we're not giving enough attention to how strong demand has been, primarily because of mortgage rates. All right. Sales volume has actually been up for 10 months in a row now. And you think, well, how could that be? Because buyers are buying everything in sight. We've been able to outpace last year's numbers even with less supply. Here's the region. January, February, March in 2021. Look, compared to the last couple years, our first quarter outpaced the previous 2 years, and it's been a pretty strong first quarter, in all of this. Okay, here's a wider look. Let me let you unpack that later. But here's Sacramento County, and again, Sacramento County was higher than the past 2 years, a little bit lower than some of the previous years, but still a strong year. Here's Placer County. January through March has clearly outpaced many previous years. Okay, and here's El Dorado County, has far outpaced for what we've seen previously. And so if you think about your book of business, where are people moving? pay attention to the stats everywhere. There's increased attention on Placer and El Dorado in particular. Okay, I'm going to pass through some of the stuff. You can check it out. The good news that, and I have a few more slides after this, is that we are seeing more listings. In fact, I think this is great news. Okay, this shows sort of the rhythm of new listings in blue since 2017. There's more new listings in the beginning of the year, and then there's less as the year ensues. There's more at the beginning and then less. And so there's this rhythm. What happened during COVID in blue last year is that listings fell off a cliff for a while. Sellers didn't want to list their homes. They pulled them from the market. There were a lot of cancellations. And look, we didn't have a normal year last year. A normal year should have gone way up. Okay, but then sellers got used to the market again, and we began to see more new listings, but it's been nowhere close, to where it should be. Okay, but look at this year. I would say that we're starting to approach very normal levels of listings. Okay, but you know what the problem is? Demand is so high that buyers are gutting the market out there. And so you can look at the number of pendings in red each year, and right now pendings and listings, they're just about the same. And so it just shows that buyers are gutting everything. But in a healthy market, look, there's always this gap. There's this space between the number of listings and then the number of pendings. Right now, we don't have any space, and so that's why things feel so chaotic. Okay, the good news is we've seen more new construction, as much as we've seen since 2005. There are about 7,000 units built last year per North State BIA. Here are sales in March. March far exceeded any previous year in the past decade, and so it was a very strong March. All right. If you've been to Home Depot or Lowe's lately, has anyone done any home improvement projects? 2x4s cost $7. Okay, $7.09 for the cheapest 2x4. This 2x4 used to be less than half of that a year ago. Okay, lumber has risen dramatically. Here's lumber per board feet, 1,000 board feet. It's just seen explosive growth. And unfortunately, this doesn't help with housing affordability, and it doesn't help more units get built because they're simply more expensive to build. And so this is a real bummer. Okay. A couple graphs, and then let's close this thing up. Here's the median price in Sacramento County since 1990. And you could see this is the nominal price without adjusting for inflation. I'll show you that in just a sec. You can see that the nominal price, the median price, has outpaced where we were in 2005. Okay, we're clearly above where we were, but you can kind of see this rhythm to the market: down, up, down, up. And at some point, wouldn't it be normal for a market to go down? I would say yes, because that's what markets do. Okay, now we adjust this for inflation. And it's interesting because when you adjust for inflation, we're actually not back to 2005 levels. Okay, but here's the thing. In our market, we spend so much focus, so much time on, are we back yet? And are we going to change like we did back then? And I just want to say that it actually doesn't matter if we get back or not, because what happened 15 years ago has no bearing on today. It would be like, look, in the 90s, we saw about a 10 to 15% haircut on the market. In 2002, people could have said, hey, we're back to those levels. The market's about ready to implode. But then the market went up for another 3 years. Okay, and so I just want to say that it doesn't matter where we were. But here's the thing, some people are eyeing the market, and some sellers, I would identify them in your book of business who feel like, hey, we've had about 10 years. I'm ready to make a decision. I'm ready to cash out. Okay, as long as you can find them something, great time to sell, right? And so look for those sellers. I did talk with someone a few weeks back who wants to sell his home because he senses the top is near and he's going to rent. And I just say, look, sometimes if we did have a market collapse eventually, the last time around, it took 6.5 years for prices to decline. And so how long are you going to rent for, right? And so it's a viable question. And I'm not saying there's going to be a collapse. Here's Bitcoin, though, similar dynamic, and where everyone's like, oh, it's going to collapse, it's going to collapse. And other people are saying, no, it's going to go to 100,000, and this was Bitcoin this morning. But Bitcoin, when it got back up to the previous level from, a few years ago before it collapsed, that didn't mean anything. It was able to surpass. And so I would just say time out. Let's stop focusing so heavily on 2005, and instead let's look to today's market. Who has incentive to buy and sell regardless of what prices are doing. A quick closing X factor and then some closing tips for you. What mortgage rates do in coming time means a great deal for this housing market. Okay, mortgage rates have basically gone down since 2018. The market got really, really dull in 18 when rates were about 5%. And so rates, the market's gone crazy since they went below 3%, but look, they've gone up recently, and that can change the way the market feels. It hasn't yet. Okay. And then, of course, rates went down over the past week or two. And so that could, again, supercharge the market. All right. But when we look at refinance volume, okay, this is from Lundquist, Freddie Mac economist, refinance volume has taken a hit over the past couple of months since rates went up. All right. And purchase volume declined for 3 weeks in a row recently. I'm not sure what happened last week yet. And so you can kind of see on the back end, when rates start to rise, a lot of buyers rush the market, but there's also this effect where some buyers have backed off a little bit. Now, we don't see that in the stats yet. Our market is bananas right now, but what we want to pay attention to are the number of applications happening, because that could eventually show up in how the market feels. All right. And again, with rates going down again, maybe that'll supercharge it. Maybe in coming weeks, we'll see there's more mortgage applications, right? But ultimately, higher rates really do matter. We have a market that feels contingent on low rates. As soon as rates went down below 3%, it made things crazy. Okay, so that's like one of the 3 legs in our stool, and you begin to see change in that stool, then it begins to change the way that we feel. Okay, then the last X factor is the vaccination plan. As long as we're in this pandemic, the market's poised to be more aggressive, inventories poised to be tight, and until we feel totally normal, I think we're poised to see, this type of market. Now, people ask, is this type of growth sustainable? I don't think we can have 20% growth over time and call that sustainable. Something has to give with that sort of aggressive appreciation backing off eventually. Okay, that's not sustainable unless there's other factors that help make it sustainable. 5 quick thoughts to focus business in 2021. I just say, adjust your narrative based on the stats. Don't be afraid to say something different about the market. If you are a real estate professional here, that's the best thing you can do. 2, I would say be prepared for bubble conversations, but don't obsess over prices, okay? I'd say if you work in real estate, build your business based on lifestyle rather than what prices are doing, okay? If you build your business on it's a great time to sell, it's a great time to sell, and then eventually it's not so great of a time to sell, then your narrative is really, shot yourself in the foot. I would say that maybe a great way to look at the market is it's a great time to do all this stuff, but regardless of what prices are doing, who are the players of the market right now? Who has incentive to buy and sell regardless of what prices are doing? I'd say own the narrative of the market, okay? Know your stats. Or the tech companies will own it for you, right? I mean, that's the reality of it. I am owning the narrative of this market, and I welcome you. Let's join forces and own the narrative together. 2 more things: identify who's thriving and not in this K-shaped market recovery. Okay, the market's beginning to recover. The economy is recovering, and we want to identify, who is doing really well, who's not doing well. Those are 2 different groups, and they have different needs. Identify those needs. Ask yourself who those people are. Okay. And I just say, last but not least, don't keep doing the same thing, because it won't work in every market. Okay. And those are all geared towards real estate professionals. If you're still here and if you're a buyer, I would say hold out hope, but just realize that 2 things. Number 1, if you feel comfortable with the prices, realize that most people buy based on their lifestyle. Okay. I don't want to talk you into anything. Okay. Number 2, if you don't feel comfortable with prices, then don't buy. Okay. It's as simple as that. Okay. But I want you to walk away with confidence in the decisions that you're making. And I hope that it helped with some stats. This is me. This is my contact information. I really appreciate it, guys. We took the full hour. I hope your head doesn't hurt too much, but I hope you're able to walk away with some value, some things to share about the market.